to Trent Collett from Peter Bell, date May 4th, 2020, regarding placer miner in a pubco. So basic idea is to print shares in a public company and give them to a placer miner in exchange for a stake in his production. And then you can sell that at a premium valuation for more money. You can sell that for a profit, for cash. You know, like, what's a PE multiple on placer earnings, Trent? 20 times? Two times? What's the premium on a physical gold stream as a distribution? Like, what is a shell that has a gold stream coming into it worth versus one that doesn't? If you have to print shares or enter into agreements to get that gold, it's worthwhile. Literally worthwhile to print shares in your public company to buy grams of gold. In British Columbia, from placer miners on a carried interest in the production. You get like a 20% NSR on some placer stream. If somebody's producing 1,000 ounces a year, maybe like 10,000 ounces physical. I don't know what people are capable up there of. I don't know what the gross production is of placer gold in the Barkerville camp, but I know Omanika is talking about some phase 1 program that's like $30 million total operating gold revenue. 30 million. Omanika, the public company, has 35% NSR effectively. They have a 35% royalty interest on $30 million of revenue, which is a top line number. So you're literally looking at $10 million revenue in phase 1. I don't know how long that takes. Is that 8 months or is that 18 months? I've said before, I don't know. I still do not know. But I've heard Tom McNeil say that there is potential to be mining there for decades on their ground alone. I don't know what to think of the entire area. There should be a lot more gold production coming out of that area, and any way to securitize it to give people a way to gamble on it in a public market setting is a totally smart thing to do. What are you talking about? Digital coins, like the tokens, the gold production tokens? Get out of here. Those things are out of control. Who has those for placer gold out of BC? Like, where is that? Omanika is getting some amount of physical gold. Is it payable? Pay a dividend to shareholders? Pretty cool. One of the things I've talked about is doing a private company and having the private company have the workers own part of it, and for that company to pay a dividend in gold. And so the example I talked about before is Omanika owns that private special purpose vehicle because it's on ground owned by Omanika. And it's strictly non-mechanized mining is the plan that I proposed. and it's basically going to be me and some friends. Like, we're not ready to do it yet, but we have a chance to give it a shot this season. We'll probably do so. Right now, you know, talking about all the things you can do, standing here in Victoria with the microphone in my hand. So there's literally no one outside. I'm the only person outside. BC government announced gradual easing of restrictions today. I don't know what that means. Doesn't matter. The Wing Dam mine site operable on a physical distance basis. Through pandemic, you could be doing placer mining. Underground work, maybe. You know, what's the mechanical future of underground mining at Wing Dam? Anyways, right? Where are the mining robots to go in and do this narrow vein mining technique on gutter, creek beds? You know, it's like dynamic tracking or something, modular, you know, like ore hunting mining robot to go through the creek bed at the Wing Dam, like a turbine or something. Big drill with a bunch of reorientable directions and things. The technology you can do there is out of control. Just get stuff from oil and gas. Get the oil and gas guys to come in and use the coil tubing as well. You can get like good extension and drilling without having to deal with rods much if you do coil tubing instead of tube drilling. If you use a coil, it's a technology developed in Australia. If you use the coil technology, it's better for tighter quarters underground, and you use like electric engine and there's a lot, again, technology that you can do down there, and your sluice box and everything, your gravity tables, your separation routines, like lots and lots. Wonderful work. Trying to do it all underground seems crazy, but then again, you want to handle as little material as possible. So you do what you can. You try and get some gold production out of it, and it's highly uncertain and it's very expensive. These crew underground is freezing the earth at depth on the creek bed. They're freezing the surface rocks and going in underground. Like, what? That's, how much does that cost? Yeah, who knows? It's a group from Saskatchewan, legacy mining contractors doing some epic work. So we rival them at surface. Who can produce more gold? You know, a private company that gives a carried interest to some other shellco, or Omanika itself. I bet you could beat Omanika if you tried and you had a good sense of things. If you capitalize too, just commercial placer on an ongoing basis, like partner up with buy a 30% interest, carried interest on a production stream from some producers, like by their profit, maybe, with shares, and then help them, 10x the value, and like give them some warrants or something, special warrants, convertible in gold, right? Special warrants in the pubco, thank you very much, that are convertible in bullion, gold, doré, not bullion, doré, or cash, or nothing, or in a carrot, whatever. Talking about the types of dividends that Omanika could pay, and any company doing this kind of underground or surface. And alluvial gold mining, high grade alluvial gold mining, low grade alluvial gold mining, profitable alluvial gold mining. If you can do that, is a good investment. And like, you can have impact if you have a crew that's got equipment. The operating costs per day, like 1,000, 2,000, like 5,000 per day, maybe 10,000 per day. If you paid $10,000 per day operating costs for a placer operation, you'd be paying a lot. You'd probably be paying too much. Then again, it's unknown, So, yeah, this is it. A public company that can buy a stream of gold production for shares. That's a good deal. So one way to do that is to form a pubco, to become a related party entity, where the pubco does contract mining. It's an operating company that like contracts out with other service providers, like whomever. There's a few names that come to mind, but I won't mention them. I'll just say, in general, that company just starts on its own. Just be in business on its own. Hypothetical business. Contract miners. Totally debatable, contentious thing. Like, is that possible? Can you hire a crew? Who knows? It's not the issue if you're talking about stock market transactions, so, because you can create wealth, you can create cash, you can create more cash by doing paper deals in the stock market. So the initial paper deal is putting up some money privately to start a for-profit contract mining deal, and then to put it like $50,000. How far does that go? Is that 5 days of operations? Is it 10 days? Is it 10 days? How many grams of gold could we get in 10 days? Like, could we be profitable on a 10-day basis? Can you put up $50,000 Canadian? It's pretty wicked. But say it again. The Shellco has a $1 million valuation. It's hard to do much of a deal in it. If the Shell has a $500,000 valuation, it's still pretty hard to do any business. You could do an equity financing, like 50 grand. That's like 10% dilution. That's all you can do for 10% dilution. Question, what can you do for $50? And the answer is quite a lot. $50,000. Where can you get it? Lots of places. What do you mean? What can you do with it? Well, you can put it towards a campaign of placer mining with some people, and even do it on a good faith basis, right? Pay a partner I don't even know if the guys from Green River Gold CCR, he says he can't do it, doesn't work. Hiring contract miners, all your gold gets stolen, and he's right. So, it can happen. I know a way around it with Omanika that we should do, and that I want to do as a private company, and that may be where I do it first to demonstrate possibility of the thing, and maybe get HCC to help me and some buddies, like potential to have a mini trommel going at surface, powered by water. Pretty encouraging for running potential pay dirt. And at the surface at Lightning Creek, at the wing down, you have potentially rich pay dirt that needs to be sluiced every year. Like every year of the history of this thing, you need to, because gold's still coming from somewhere up there, right? Like that's literally happening. So finding the mother lode, doing that on placer first is even better, because you're mining it without having to have a mining permit. Like if you do non-mechanized mining, you literally don't need a permit to work. You talk about how far does $50,000 go. Think about that. $50,000 when you don't need a permit to work. If you own the claims cost maybe $2,000, maybe $1,000 to cover, like an old mine site. Places you could find more pay dirt, more reasonably expect, benches or pieces of creeks. You wouldn't want to stake those before you've been to them, because there's so much potential. But the good thing is you can go with hand and test anywhere. Any property, there's rules where you can test it for gold, a penny. And that is something you want to do on a scale basis, because it's highly return, good thing to do. Trent, it's so simple. Print shares to mine gold. Economic machine where you create shares as equity, and you add assets that are produced gold. Accumulated position, like cash balance and payables and other assets, like an entire balance sheet. But you literally have an asset equity match of gold potentially, if you can find a place to do that. And anyone who's running a placer mining operation in the Caribou right now is a target for some public shell company to do a deal where the miner gets like carried interest in the public company, right? Like, talk about a carried interest on the mining, talk about a carried interest on the shellco. You know, it's against dilution. And the goal is to be profitable, you know, from the beginning, right? Start it privately and show that it can be profitable, and then vend it into the pubco, you know, for equity, and then use the pubco to pay the placer miner for some interest in production, right? For profit from the start, scale set to grow, simply operated, you know, carried interest in the profits for the first operator, right? And yeah, quite a silly. It's really a financial arrangement, financial engineering, financialization, whatever terrible words you want to use. Talk about it. Simple deal. One way to think about it from the perspective of the placer miner. So if we think about what this person does, how they live, you have to have a lot of respect for them. And they stand to win, right? And a good way to do that is by getting involved in seeding transactions in the stock market. So specifically instances where the placer miner puts portions of the profits of his operations into specific shell companies. So yeah, and the amazing thing about this is that you provide no warning. Basically no warning. Literally means you announce a transaction and immediately it's cash flowing and positive and you start receiving income. Right? What does that entail? Well, it's a pretty impressive transaction. Pretty impressive indeed. You know, if the public company wants to get cute about it, it can distribute the gold doré to its shareholders. That can be one of the most tax favorable decisions you can possibly make in some instances. So it's a great example of what you can do, right? There's so many options, so many great things that can just create so much value. Like if you have a new shellco that's receiving 1,000 ounces a year, 4 ounces a day for 250 days, or more if a shorter season, which is probably more realistic, right? Like in 100 days, what could somebody in the Caribou do? I don't know. 1,000 ounces, maybe. Let's say 1,000 ounces to 100 days. So is that 10 ounces a day? Is that a reasonable production rate to ever consider? Or is that totally unreasonable? I think Omanika Wing Dam project, they talk about 300 meter initial area, and there's some number of ounces per meter, like 7 ounces per meter. So it could be 10 ounces per meter production over rich segments of the wing dam. 300 meters initially, 3,000 ounces. So 3,000 ounces, 2,500. That sounds more like 7.5 million, not 75 million, not 30 million. So I don't know what number that is, if that's correct or what, but it's quite a lot of production potential in 100 days. The question is, how do you capitalize it? How much does it cost to do it? Who's going to do it? Where do you do it? When do you do it? So you get good answers to all these questions by working with people who know what they're doing, right? You put this in a stock market play and you can't provide any guidance because it's not 43-101. All you can do is just report on profitability. It's and losses. But the structure of the deal is such that the pubco never experiences losses. It either receives zero or a positive amount, which is unheard of, right? A royalty? A 35% royalty? 35% royalty is basically what Omanika has on what might be Canada's best underground mine in 2020. Probably will be in 2021. If not, it'll be something in Saskatchewan, probably, maybe other places too. But having these Saskatchewan miners working underground in BC is huge. Having BC miners working at surface is huge. And having a pubco that does a swap deal, shares in the pubco for a royalty on production, like, that's good business, right? And again, if you can't provide any guidance on the production for those things, then analysts can't do any of their normal handicapping for your valuation, because you're immediately cash flowing, if at all. Or in fact, you are immediately cash flowing, because we're talking about a royalty on a placer production stream. And at other places I've talked about how a placer stream, gold production stream, is faster to return, the final return, than an exploration project, right? If you compare investing $1 million into exploration versus operating a profitable placer mining company, and then, you know, maybe having a 30% carried, 20%, I don't know, what's the number? Some royalty rate on production. You spend $1 million on operating a placer. That's putting $1 million into a profitable placer operation in one season could potentially give you back $2 million net cash, like, or it could give you a 2 million cash position, or it could give you, like, think of how many ounces it could give you, right? Like, say it's $2.5 million worth the royalty payout, right? What is that in ounces? Really, 1,000 ounces. So normally, if you have a royalty on a copper mine, gold gets separated at the smelter, and you never touch it, you never see it, you get paid for it. The placer gold mine, things are different, and you do see the gold, and you do have more options to do more interesting things with it, right? So investing in placer production is a premium, like creates a premium return stream, because it's payable in grams of gold, and you know, the costs are in Canadian dollars, and the proceeds are in gold. You know, alluvial gold. It's like high quality alluvial gold. What's the value of that? Like, melt down doré, distribute doré to shareholders. Again, I've said it before, this is one of the most tax favorable distributions you can make in the history of all mankind. Distributing doré. Bullion, I don't know. Cash, obviously. And I don't know if it's true, but my understanding is that distributing doré, gold, silver, maybe just gold, I don't know, is tax-free distribution. Well, maybe, I don't know, maybe not. But there are people who would pay for access to a gold stream, because there's deep uncertainty in the world about the security of the supply for ounces of gold. We don't mean security, supply. I don't, like, there's lots of ways to interpret that, right? And there's lots of them are relevant. Local production of money is valuable to a society, right? Like, British Columbia is a better place for every ounce of gold that someone mines here. Or we're doing it wrong. I don't think we're doing it wrong. I don't think it has to be wrong. I think we can do it right. I think it can be safe. I think it can help the world, the earth, and might not be damaging, you know, total disaster scenario. Do things safely so people don't get hurt. Make money doing it, right? All those things are possible. I think those things are more possible in British Columbia than they are in Papua New Guinea. And we talk about sending 100 different gold, like 100 gold pans to the jungle, to our friend down there, Trent. Talk about buying 100 gold pans in Australia and shipping them to Port Moresby for Moses to take to the jungle. Man, I still want to do that. Like, and then I want to have a dozen or 2 dozen pans ready to go, and just pay day laborers like $20 an hour or whatever to go and pan gold all day, all night, in crews of like 20, you know, just like spread out. And so physical distancing, covering large areas in the woods, like the area in the mountains up by Lightning Creek there, Like I've been looking at Mount Pinkerton, and the mineral claims are owned by the one and only Osisko, Barkerville Gold Mines, formerly other things, and then they own the placer claims on part of the mountain, but not all of it. The south side is a steep drainage that's completely open to placer claim. So you could go one hillside over from Barkerville where Osisko has 2.4 million ounces in categories on its website. 2.4 million ounces. Underground resource. There's been mining there. They will be mining there again. It's a great producer. You might see 600,000 ounces come out of that deposit for years and years and years. And that's a huge amount of economic activity for BC. So more of that, the better. 2.4 million ounces. Maybe it's 8 years, 300,000 ounces a year. Maybe 600 ounces is too aggressive. It's okay. But whether it's that amount or it's 600 ounces from the jungle, like you want to have that, you want to see that impact on gold production wherever you can. And placer is somewhere in between the extremes, right? Because it's in BC. There's a possibility of doing it within the rule of law, of like Western society or whatever. It's like legal arrangements that allow for, financialization and securitization of ideas and interests, and just dealing with royalties and chopping these things up and saying who owns what, who gets paid from what, like how, and who pays for and who does what. Like there's so many questions, but simple ones are, can you do profitable production? Is there a miner who's doing profitable placer production who will sell an interest in his revenue stream? Right? Buy a royalty for shares and give placer miner a return, right? If the placer miner's production stream returns this interest like $5 million over what? First 2 years? Maybe? 18 months? $2 million in 18 months. $2 million in 20 months. How about that? That could be, I don't know if the placer miner would work continuously over that time, so it might be chopped up a little bit. But if it's 20 months, we're talking 100 ounces per month. I don't know what the numbers are. There's lots of numbers to calculate and figure out, but the basics are so surprising that you could take private production of gold from placer mine and turn it into stock market paper on a royalty position. That would be a very unusual transaction, but very, rewarding potential. If you even just at $1 million of income in a private company is $1 million of income. If you have that same income associated in a public company, like what's it worth? If it comes out of nowhere and there's no 43101, no economic study, no guidance, to tell you why it's $1 million. It's just $1 million in the first year. What's that worth in a shell? In a bull market. 10 times, 100 times, 1 time, 2 times. I don't know. But the potential to put a production stream like that into a public company is just shocking. So the question is, how would the placer miner agree? And it has to be a case where the placer miner understands how much money he can make continuing his operation at cost, giving up the profitability of his operation to the public company, and then expanding his operation. He'd have to have some special arrangement with the public company. And the simplest thing is just a 20% anti-dilution clause, where every time the company issues shares, they get compensatory shares to the amount of what is needed to change them to 20% interest from the company, and it continues. Unclear if the placer miner wants that directly, so there may need to be a shellco that has that arrangement, right? And that's probably where you would put the royalty on the placer miner's production. So the placer is a continuing operation of a profitable placer miner. You take the profit stream and you put it in a public company, and you don't, no economic guidance again, because it's not 43-101. It's just some amount of placer production. It might continue for some amount of time and then may stop or start again without notice, kind of, right? Best efforts basis by the on behalf of the placer miner. That's all that's required. And so long as that agreement is in good faith, also, fix the ownership in the shell pubco at just under 20% for the placer miner. Any dilution, any financings, the placer miner gets more shares to match. And if you really want to be bullish, you add a condition where placer miner can sell up to 5% of their position and then have it refilled. And can repeat that so long as placer miner operations continuously ongoing, right? So you give the placer miner a way to sell shares and then re-up for free, and also to keep up with any other for free, and keep a 20% interest in the equity of the shell, which initially is $500,000. The shell valuation, $500,000 for a busted TSX venture or a CSE listing like Next. Who knows? There's some cheap public companies out there. You get one of them, and it's like, how do you even invest in it, right? So small. How do you put any assets into it? And yeah. So in effect, what I'm talking about is you capitalize the cost of operations for the placer miner by giving them shares in a public company, right? If you understand what that means, it's the reason why you'll be able to create the equity account, the equity entry on the balance sheet that is the shell of the shell, the equity line entry that is the 20% to the placer miner co. And then you think of this placer miner co and what it's doing. Well, basically it's receiving a royalty interest on a production stream, which is the third party in the arrangement who is the original profitable placer miner. We find someone like that who's willing to sell off his profit stream as a royalty. We put that cash flow profile and gold production stream into a private company. And then we take that private company to a shell. And the shell gives 20% of itself to this royalty company in exchange for the royalty. Say that's the arrangement. And it's a situation where that royalty company doesn't really have any security. It's doesn't have much of an agreement, I don't think, in place to stand on. And what's more, there's no ability to handicap or guesstimate the amount of production to expect, because it's an all 43-101. Placer mining is inherently risky. The risk is there. It's probably even worse return profile than exploration in some senses, but in others it's probably better, right? Like, the key thing I like about the placer story is it's quick. You can find out immediately what the return is. It's not likely to be 1,000 to 1 exploration success, like hard rock discovery successful sale. Excuse me. So it's quite a lot of information to digest. 48 minutes. Sorry, Trent. But it's all, so I want to share with you, because it's real. It's real. And I don't know if every shell would float the idea or would try it. I can think of some where they'd probably say no to doing anything. Of course they would. Lots of them would say no to doing anything to do with placer gold mining in BC. It's totally outrageous to most of them. Most, even explorers in BC would say, what are you talking about? Taking a shell and the only thing in it is a royalty interest? Maybe it's not even that's a highly valuable asset to put into a shell pubco, right? Speaking on behalf of myself, that's a smart deal. Put a cash flowing asset, a royalty interest, non-recourse, non-cost. Just put a positive cash flow stream that's uncertain and unknowable into a public company and see what happens. Amp it up if you can, right? And the way to make all that happen is to align the incentives in the first place. So the way you do that is you give the guys who are doing the work big interest. And since it's public companies, there's like rules on how much people can own. 20% starts to get to be the max. So you want to introduce a situation where you give them a carried interest, an anti-dilution clause, a carried position at 20% of the company, right? And I've said it before, I'll say it again. Even if they sell shares, they're allowed to go back up to 20%, so long as the placer miner is ongoing. Maybe there's some limits on how much they can sell, 5% per year, and 10% per year. I don't know what the number is, but imagine that. Imagine the first year, what does it float? $500,000 profit, 3 quarters. What is the profit line of a current placer operation? A successful one. $500,000? Maybe. Is that their annual profit? Probably. Enough to get them through to next season, assuming no big expenses. $500,000 profit. Sounds like a lot. It's probably not very much. Can they afford to give that up for shares? Yeah, I think so. Right? There's got to be a way to make that work, because the value of that cash flow stream in the public company is a multiple of what it's worth outside. So if we have to pay, the deficit, $500,000 to the operator for his lost income, but the market values his $500,000 of cash flow at 10 times, then, it's a $5 million impact on market cap, right? On a cash flow basis, right? $500,000 in cash flow in the first year profit. What do you give that, 20 times? Is that $10 million valuation? Ugh. For a $500,000 profit line, a $10 million valuation, a 20 times PE multiple. Is that conservative? Remember, this is a growth stock, right? This is supposed to be one of the most growth-oriented investments of all time. It's like junior mining. Discovery happens so quickly. Exploration business, absurd. The extremity of the returns. It's so great that makes us forget about how often it's just a loss, an accumulated hole in the ground. But again, if you can do it, is an accounting transaction. We capitalize the costs of a placer miner, and then we put the profit of that miner into the public company as a royalty interest. The market would value it above that, and you would maybe you would pay the placer miner on a going forward basis. You know, as the G&A went up for the company, maybe you could afford to pay the placer miner, instead of $500,000 to live on for another seasonal mining, pay them some amount from corporate, and for us to have some private interest paying for the ongoing placer mining activities. You know, like, I don't know. Everything is possible. There's a lot of different things. So I'll leave it there.